Why would I invest in capital cities? What does the data say?
The long-term buy and hold numbers, boring numbers in regional are less attractive than capitals.
You have left millions of dollars on the table. Millions of dollars.
Regionals, I would say, are going to definitely outperform doing nothing.
Everywhere you look in Sydney 30 years ago looks fundamentally different to the way it does today.
Does it make sense for me to continue holding in this regional area, or should I be taking my capital out and redeploying it somewhere else?
Should I be buying in regional or metro areas? In this episode, Curtis and I are going to go through a little bit of a debate and go through the pro-regional, pro-metro, pro-capital, and go through a little bit of a deep dive into which marketplaces suit you. And the answer here is not the same for everyone. Many great property investors stick to capital cities only. Some buy regional markets for better affordability and do really well with it too. Kurt, what do you think, man?
We got to choose teams, right?
I like this.
I take capitals.
Okay, I will go regionals. Let's go. All right, so let's start with the context. Why would I invest in capital cities? What does the data say?
Yeah, well, you're investing in property, my assumption is, like, to get capital growth and yield, right?
Yes.
They're basically the two things you get. So if we're looking at capital growth, at least historically, we've got some stats here. 10-year average, like capital growth rates, regional versus metro. This is all like combined. 5.2% for regional, 7% for metro. So metro or
Fudge!
capitals.
Hellos! Hellos! Cool.
Coming out slightly ahead. The part that, like, this is averaged, if that makes sense. So what I would say is you're going to get different results depending on what regional area you invest in.
Isn't that what I'm supposed to say?
Oh, yeah. But, like, just to, like, because I'm...
You're debating yourself here, man.
If I was listening to this, that's exactly what I'd be yelling at the YouTube, like, on YouTube, being like,
Debating
that's
yourself,
average, you idiot. Like, it's different everywhere. Like, yes.
I don't think our audience is as clever as you. I know this because nobody's as clever as you. I've learned that. Even my little ChatGPT robot that talks to me, which does actually talk to me now. Did you know that? ChatGPT talks to you. ChatGPT talks to me.
Slightly creepy.
Yeah. It's actually...
So can we just wrap it up there then? Like, do we actually, if I'm cleverer than you, does that mean I win? It's over?
Maybe I should ask it live on this podcast. Be like, ChatGPT, which one would you go with? It'll probably give me some long-winded nonsense answer. So, yes, that's very true. What did you just say, though? Can you give me those two numbers again?
Yeah, 5.2 average for regional, 7.0 average for
Damn,
capitals.
man. Damn. So, like, if I pan this out over 25 years, regionals suck. Like, comparatively. My $2 million
Yes.
with a 1.8% different growth rate. I'm talking about millions of dollars here. Like, that's
Yep,
all. That's,
if you got the average 5.2 and I got the average 7.0.
Let's link this back to our episode where we said where we get rich slow. So, what did you give me just there? So,
5.2.
$2 million
Yep.
times 0.0152 over 25 years. We're doing this live as we go. Far out. That sucks. I only have $7 million. If I put $2 million down, got into regional marketplace, let's just put aggregate regional down. Over 25 years, I would have about $7 million. The asset, that $2 million will be worth $7 million. If I did the same thing
It's going to be slightly over 10.
A mix of capitals.
At 7%, it's going to be 10.
10.8. This is a
10.8, almost
3.8.
11.
Oh, man. Oh, what a stuff up. Cool. Everyone, if over 25 years you invested in a regional sort of ETF group of regionals and achieved the regional return, you have left millions of dollars on the table. Millions of dollars. Wait. Which one am I representing? damn. Oops. I worked out. I'm wrong colors. Curtis and I are on the same colors here. Okay. Right. Let's get back onto team regional. Let's go. Keep going. Tell me more. Let's go state by state. We got more data here.
Yeah. So let's have some 10-year averages for some different places.
Yes. This was from Core Logic. I love this one.
Yeah.
It also made me very sad for the argument I'm trying to make right now. Go.
Yes. Okay. So Townsville, one of our...
Do we have state by state? Like, there's a little table in the analysis that we put together, Kurt. You mind sharing?
92 to 22. Yes. Okay. So state by state, capital versus regional. So if we go
Over what time period?
1992 to 2022. So 30 years.
30-year time period between capitals and regionals. Tell me the performance. New South Wales.
New South Wales, Sydney, 449%.
Boom,
over 30
449%. Regional. Has it done any better?
No, 191%.
Wow.
Very, very different.
Man, you can buy some cheap properties in regional then right now.
Yeah.
Cool.
Do you want the Victoria ones? Maybe do better there.
Yeah, let's show me Victoria.
Yeah, Melbourne, 459% over 30 years.
So the interesting thing though is Sydney and Melbourne have basically grown exactly the same amount over 30 years. Just throw a dart at either of them, they're the same.
Yep.
Cool. Next.
182 for regional Melbourne.
What? Cool. What else have we got?
All right, Queensland.
I like
Maybe
that.
you do better there.
Probably
390 in Brisbane.
Hasn't even doubled in 30 years. Hasn't even doubled. Well, Melbourne's like 4x'd.
Yeah.
4.5x. Yep. What have we got next?
390 in Brisbane.
Brisbane. Cool.
Yep. 205 in regional Queensland outside of Brizzy.
Cool. At least regional Queensland has like doubled.
Yeah. Maybe Adelaide. 370 in Adelaide. Regional South Australia. 159. Do you want the next one?
Yeah.
These
Is
making
there
you sad.
Is there anything positive in here? Man,
No.
you chose the right team
Yeah,
to
yeah.
fight. Curtis is
I
whooping
stacked
me.
the deck.
Curtis is whooping me. He's
West-
using data. He's using numbers. He's getting the stats out. Come on.
Perth 325 over 30. Regional WA 168. And then Tassie 423 for Hobart 189. So unfortunately, state by state doesn't really come out any better. The
Comes out
averages
worse.
state by state are still, it doesn't come out any better or show any real differences to the national averages.
Okay. So over a 30-year time period, if you invested in regionals, you would have left millions of dollars on the table, and it's pretty much uniform across all of these capitals. What about Townsville, man? Townsville's rocking.
Yeah.
Townsville, Mackay. I've done podcasts with Matt Wilson on this stuff. We've talked about Mildura. We've talked about Shepparton. We've talked about all these regional areas that are doing really, really well. Like, surely these numbers are better, right?
Yeah.
Do we have anything?
We've got a 10-year annual growth rate for these ones.
Yeah.
So not even the whole 30 years.
We even shortened it. We
Yeah,
even took
yeah,
the
yeah.
bad bits out.
Exactly.
Kept the good bits in. Tell me,
Townsville 4.9 a year.
compound growth rate.
Compound growth rate.
Yeesh, that's not good enough.
Yeah.
What have we
Bendigo, another hotspot, 5.0. Still not that crash hot. Dubbo. I don't know why we chose Dubbo, but anyway,
Doing well at the moment.
doing well at the moment. It's got a nice zoo, apparently. 5.7% Dubbo.
That's pretty good.
Suburbs of Western Sydney, though, 7.5.
Damn. Okay. Is there anything good here?
Inner city Melbourne, 4.5. So worse still in Melbourne.
Yes. I picked Docklands Apartments.
Yeah,
Yes.
Docklands Apartments, not so good. But the one that might hurt, outer suburbs of Brisbane, 9.0.
Wow. Okay. Cool. So data objectively says that capital cities outperform regionals over a 30-year time period over long horizons. In Australia, that has happened. Makes a little bit of sense. It probably applies to your preconceived notions and biases that exist. Capital cities will outperform regionals. More and more people will flock there. Growing, burgeoning capital cities, land becomes scarcer. That land gentrifies over time. The land increases in value over time. Those turn into apartments. This is all happening. This is part of the reason why the outperformance of land has occurred in capitals, because none of this happens in a regional location, because the population growth story is not there. And even if it is there, the urban sprawl of a regional city is often like, oh, I can go 50 streets back and I can build this regional city 60 times over.
Yep. That's my argument. I don't know what you're saying.
Well,
Yep.
yeah. Cool. So are we just saying capital cities are better than regionals? Like, there's a more nuanced perspective here. It's more about.
So I would say if we go back to that podcast that we did a while ago where we were talking about the get rich boring 25-year plan.
Yep.
If you're just going to get a map of Australia and throw a dart at it and you're going to be like, I'm going to buy something and just hold it for 20 years, 30 years, very, very passive investment.
Yep.
Then I would say, yes, you're going to have a better run if that dart lands in a capital than if it lands regional. But there are other ways to invest. Like I would say, because the numbers, the long-term buy and hold numbers, boring numbers in regional are less attractive than capitals. Like, doesn't mean you can't invest in regional, but it probably means to me the more active investor, someone that's looking to do something, buy in, make some money, sell out, reinvest somewhere else, maybe getting in at a cheaper price point, they're looking to be more active than just a boring 30-year buy and hold, is where like you can get some value out of the more regional investments. Like I think the 30-year buy and hold, you're going to struggle to beat capitals.
I agree with that, man. Like the long-term perspective there makes a bit of sense. It's the visual eye test. Like, you know, everywhere you look in Sydney 30 years ago looks fundamentally different to the way it does today.
Yeah.
You know, you walk around like Dubbo. I went to Bendigo recently, right? Bendigo looks a lot like, I genuinely think everything I went there and saw past, I may have seen one new house built in the last 30 years. Maybe that's a bit of an extreme because I didn't spend that much time there. But you go around there, like the capital, it's beautiful. I'm like, wow, it's gorgeous here because it's all old stuff, hasn't changed. Like, and that looks beautiful now. It's like, hey, everything in Sydney looks different now. There's a lot of new buildings everywhere. Right?
Yeah.
Land is uplifting, and that increases the value of the land. That doesn't happen in these locations. I think that's probably the summary as to why that actually happens. And longer term, I actually think that only gets larger and larger as we need to cram in the same absolute number of people again in Sydney in our lifetimes, or, you know, in 100 years, where are they all going to go? It just means everything goes up. So that is really, really interesting to know. And I like how you framed it with like, regionals can do better for now. Yeah. Specific regionals can do better for now. And over a 5-year time period, you can have regional markets completely smash the lights out. Townsville, really good example. If you looked at Townsville, we did a 10-year CAGR there.
Yeah, if you did a 3-year one, yeah.
Yeah, Townsville's outperformed Melbourne by 60% or something like that. Yeah. Absolutely blown it away, right? So you can use these regional markets to be like, hey, let's go buy in these regional markets because it's going to shoot the lights out. And the structure of investing has changed. We've touched on that with a lot of buyers agents buying and shaping the demand profile of investors to be more spread across Australia. That's fairly new. Didn't exist 30 years ago. The world has changed. So, you know, you can use these regional towns to your advantage, but you may need to be a bit more strategic with it. And if you want to implement the Get Rich Boring program that we talked about, capitals may be the better fit there.
Yep. I think the other point, and not to take the argument for your team, but the other point I would say is that it depends what you're comparing it to. So as in regionals, I would say are going to definitely outperform doing nothing. So if your borrowing power or your capital base doesn't allow you to purchase in capitals, typically more expensive, then buying something in a regional area is going to do a hell of a lot better for you than leaving it in your bank account, I would say, and just doing nothing. For sure, yeah. So
you get a better yield, right? That's probably the big reason.
Yeah, so it's not always comparing it to, well, what would it look like if I bought in Bendigo versus what would it look like if I bought in the eastern suburbs of Melbourne at quadruple the price. That might not be a live possibility for you. So we've seen a lot of investors start regional to get their foot in the door, get an asset, have it perform well over a couple of years, liquidate out, use the money from that to then go and buy in capitals.
That's a great approach.
Yeah, it's
love that. Best of both worlds. Why choose one when you could get both?
Yeah.
This is how you get both. This is really, really clever because you've touched on a big choice framework. Now, if you've got a $600,000 budget and you could access, call it $500,000, right? And you can access a regional market or you can access a unit in a capital city. I actually think in most cases, go the right regional.
Yeah.
Regional Australia, like, you know, what is that? A third of the country? Like, you know, more like in terms of landmass, but in terms of people, it's a lot of people. Like, it's not a small amount. It's a very large population base across Australia, spread across so many different areas. So the right regional matters, and this is where that data-centric approach really benefits. You can easily pick out the best regional areas. I can tell you 5 of them right now. Shepparton, Mildura, Bendigo, Dubbo, Albury, Wodonga, Mackay, Townsville, Rocky, Gladstone. There's a few offshoots in and around Brisbane as well. Palmerston, I guess Darwin is just all of Darwin, regional. All these regional markets, I just mentioned a dozen. It can outperform capitals this year. Those, you can take advantage of that. And all of that is me just comparing demand and supply right now and just working through, hey, look, clearly demand is outstripping supply. While that's happening, prices are going to continue to run, and these regional markets are going to outperform. But the long-term plan, if you just wanted to be very, very lazy and throw a couple property assets and let it go for a long period of time, then trying to find a way into capitals long-term is probably going to help you.
Yeah, I think like going through these numbers, that's the big takeaway for me is that if you are buying in a regional area, these numbers are telling you that you're not going to get value if you just passively hold it for 30, 40 years. So if you're buying regional, like there's a bit more intentionality required to have like good levels of success. You're buying in because the data looks good, and you think there's a supply and demand mismatch, and you've got a good 5-year horizon on it, or it's got a good yield, or you've got a good short-term horizon. You're looking to make your money and get out. It's not like I've owned in Darwin for 5 years. It's done pretty well. Maybe I'll just hold it for another decade and see what happens. I've had a successful investment. I'm taking my profits and I am reinvesting them either in another regional for a shorter time horizon, or if I want to go boring, then the data says you're going to have a better run if you have a boring investment in, Melbourne, Sydney, Brisbane, or capital.
100%. We're also aggregating regional and capital too broadly here. So I think that makes sense in terms of utilizing the data here, but we can get even richer. With the richness of this information that we can get through is we can look at specific regional markets and be like, what does this regional market look like over 30 years? You're going to find a couple of these are transformative. Like some of these locations. Townsville is a really good one. I actually like to think of this when I look at Townsville all the time. I'm like, it's running hot. But I also look at it and be like, it could run hot like for a long period of time because it's transforming. It's a transformative location. Cairns is another one that I look at as a very obvious one, strategic gateway. And when I go there, I'm like, this place should be very, very different over the next 30 years. It's amongst the most, it's got a strategic benefit to it that no other place across the world has, not many. It's very unique and it's dated and it needs a lot of help. So it's going to continually change. And, you can come up with cities out of nowhere in these locations, and specific regional markets can shoot the lights out and completely outperform. Basking all of regional Australia into one statistic gets a skew analysis of it. But if you put every single regional one on a sort of dot chart, you'll find many sit here that completely outperform the poor regionals, which are dragging down the average. So it's about identifying which regionals will do really well and buying in those regional markets. So buy regional, buy specific regional. That's my analysis here. I win.
Sure.
Curtis will know this because Curtis and I play soccer together. I am extremely competitive, and all of that was some rope-a-dope that we were playing, but it ultimately led to basking capitals and regionals together is a little bit confusing. Some you can do, like Sydney, Melbourne have similar growth trajectories over 30 years. If you actually pan that growth trajectory out and you included the last 2 or 3 years into Adelaide and Brisbane, you'll find that 450%, 470% growth rate is probably the 30-year sort of average across many of these markets. So capitals are actually correlating with each other.
Yeah.
Regionals do not correlate with each other when you...
Yeah, there's a huge spread. Yeah.
There's a very large spread between them. So the analysis here is don't block off regionals for your long-term investing. You need to unpack the specifics of the regionals that you're looking at and have it balanced across your portfolio. And some regionals are bigger than some capitals. Like Darwin's a capital, Canberra's a capital, if that makes sense. Gold Coast is bigger, right? Like, so the data matching here is just too broad for you to look at. So include, 50 regional centers into your analysis and be like, hey, look, these are the ones that I could consider holding on for the long term because they tick some of the foundational boxes that I need. They're larger population centers. They exhibit diverse economies that can, perform really well over periods of time, and they're going through transformation.
Yeah, but I think that the idea would be that it needs, when you're holding in regional areas, there's a little bit more maybe rigor. Not that you shouldn't have less rigor when you're holding in a capital, but like there should be a little bit more rigor or stress testing of like, hey, does it make sense for me to continue holding in this regional area, or should I be taking my capital out and redeploying it somewhere else?
Yeah.
And if that's not something that you're comfortable with, or that level of activity is something that you're not really interested in as part of your investing strategy, then that's where I think the very, very boring option, you have a safer run in the capitals. But if you are more active, like there's plenty of scope to make some profit in the regional areas, and in particular because the purchase prices are lower, to do more with less as well, which is the way we see a lot of people start.
Love that. I think the one thing that I'll add to this though is the big long-term driver of how I'd invest. Now that I've unpacked and listened to this sort of episode, or by being here, what I'd actually do if I'm carving out a 4-property portfolio or a 3-property portfolio, $2 million to long-term growth, I'd probably be buying in capital cities near a railway station that is going to have some thoroughfare.
Land uplift.
Thoroughfare. It doesn't even need it. Just thoroughfare there. Like people go to that train station. Some train stations people just don't use. Like they're just useless. But a train station where infrastructure is there, buy a house, put a granny flat on it, get to a 5% plus yield on it. That's it. That's all you need to do. If you do that, the rest will take care of itself. Australia will take care of it for you. Like you don't need to do anything else. Let me pick an example. Currently, let's pick a train station, Rockdale. If that makes sense. You buy near Rockdale train station. You buy a house for $1 million. It's probably going to rent for $800 a week. Pitiful yield.
Yep.
Get a granny flat on it. You might get $700 on that granny flat. So you spent. You can't buy a house in Rockdale for $1 million, so that doesn't work. Say $1.5 million in total. You bought a rundown house, did a little bit of reno on it. It's a 500 square meter block or something like that. Maybe that's not even possible, but in and around there, you're getting $1,500 a week in total rental income. That's a decent enough yield. I'm trying to do the math in my head, but that's roughly 5%. 75,000, $1.5 million. Hold on to that for a long period of time, 25 years. Be like, what's going on here? Like, you do really, really well. Like, and anyone who owned there over that time period, like the house I grew up in 25 years ago, guess what it is? It's devastatingly, it's still there. I see it, but it's been rezoned, and all of its neighbors are now freaking towers. Everything I walk past, and again, it's in the Rockdale location, and so many locations have already been like this. You can just take advantage of that. It's really very, very simple. 25-year play. You can just purchase something like this, but you don't need to do anything. You just need to own the land, be like, hey, I'm going to get all the wave uplift of everything that happens in these locations. Plus, when I exit, like, hey, I'm exiting into this big, giant tower that is
which
like
is just, 25, 30 years of cities doubling in population. If you're in any infrastructure transport corridor.
Pretty much. Very, very simple. A very boring strategy. And you can manufacture your way to a 5% yield by, ensuring that the asset that you're purchasing can get that. Do it in Melbourne as well. I'd probably do this in Melbourne right now. This is the Melbourne play. It's what we've actually been purchasing. Some of the ones that we're looking at and be like, this one because of these factors. Or it doesn't even need to be next to the transport node, but it's got some factors associated with it where it's just like, hey, the land itself is just so juicy. It's beautiful. And Melbourne's come up with the new townhouse code that just completely changes land at the moment, and they always do housing supply better than everyone else. This was cool, Kurt. I'm not actually sure what the answer is. So
Capitals, but
capitals.
You didn't get that?
No, but I said that there's a big spectrum of some regionals you got to buy in some regionals at a particular point in time. You got to use regionals to buy into capitals.
They're like the footnotes.
Don't buy capitals. Yeah, footnotes. Don't buy units in capitals if that's all you can afford. Use regionals instead. Buy the right regional sectors for your shorter term needs, and for longer term needs, buy the regionals that outperform over extended periods of time. And we'll do another episode with Adi Atalaya on those regionals and the long term perspective of all the regional markets that you may want to pay attention to going forward. Kurt, always a pleasure. Thank you for your insights.